following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by SogoTrade, an extraordinary value in online trading. Why pay more for the same trade when SogoTrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, and welcome back to Options Bootcamp. This is, of course, the program where we take you, the raw options recruit, and then we break you down horribly, in horrible fashion, mentally and physically, and then proceed to rebuild you into a seasoned options veteran. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And, of course, I am not alone on the Options Bootcamp Drill Instructor Squad. No siree. Not by a long shot. I am also joined by my two cohorts, my companions, my partners in crime, starting off with the man known by many as the Major Domo over there at SogoTrade. He is none other than John Critchley. John, welcome back to the program, sir.
Hi, Mark. Hi, Dan. Glad to be back today. Looking forward to one of my favorite topics, buying versus selling. The good versus the evil, the dark side versus the force. Should be a lot of fun.
Yes, a lot of good analogies we could throw on this one today. It should be fun. And speaking of dark side to my light side, I am also joined by the man wearing the black hat to my white hat. None other than Dan Passarelli, the founder of Market Taker Mentoring. Dan, welcome back to the program, sir.
Whoa, I'm just glad to be back here, guys. Welcome. I'm ready for a fun and educational session today.
You know, every time I look at you, I do get a strong Vader vibe. You know, I never really quantified it until John just said the dark side thing. Then it all came together in my head. Maybe, maybe it's that black helmet you wear everywhere you go. I don't know. From that old motorcycle injury.
My wife told me I look cool in it.
Well, there you go. Who would I be to contradict your wife? And listeners, before we dive into our Options 101 segment, I just want to let you know, if you like all the stuff we talk about here on this program, and perhaps you're a fan of one Dan Passarelli, well, then I have some good news for you. After many requests from you, the listeners, for us at the Options Insider to go above and beyond to do an event and bring our people together to discuss these topics we're always hitting on the radio show, we're going to do exactly that. Coming up next month, March 27th in Chicago at the CBOE, we're going to hold our first ever Unusual Activity Forum. We're going to bring all of our experts from the OptionsInsider.com. I, of course, will be there. We're going to dive deep into the world of unusual activity. And if that wasn't enough, we're also going to bring someone you may know and love from this program. Good old Dan Passarelli will be there, as well as the guys from Option Pit, as well as the guys from Trade Alert, who know more than perhaps anybody about options data and options unusual activity and how to analyze it, and a lot of other great stuff. You're going to have a lot of great guests. We're putting together a goodie bag, Dan, that's just going to be ridiculous. And of course, listeners or attendees are going to get a floor tour as well. A lot of great stuff coming their way. So by all means, surf on over to theoptionsinsider.com. By the time you hear this, that tab should be live. Click on the events tab or click on the little promo there and you can register for that event. Again, March 27th in Chicago at the CBOE. Don't miss it because it's going to be a one-of-a-kind event. All right, and now with that plug out of the way, we're going to dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Print bear to learn. Yes, sir.
All right, and welcome to our Options 101 segment. This is, of course, where we dive deep into the world of basic options concepts and attempt to explain them to you, the listener, in an easy listening, but not in a soft rock kind of way, but an easy to understand kind of way. And today, as John alluded to at the top of the show, we're going to dive into, I suppose you can call it the great schism, the great debate in the world of options. It is indeed the dark side versus light side, good versus evil, however you want to quantify it. Long versus short, probably the easiest way to go. But we're going to talk about the quintessential options dilemma that newcomers to this business encounter when they first start learning about options and a little bit about how to trade them. They start to encounter this debate in their own heads probably of, what should I do with these contracts? Should I buy them or should I sell them? And now, hopefully, you've had a chance to listen to all of our episodes up until this point. If not, I certainly recommend you go out and do that so you can have a little bit more familiarity with what we're talking about here today, the long premium versus short premium side of the equation. Of course, we also, on our most recent episode, episode 16, touched on whether trading long versus short going into earnings is a good idea. So I, of course, recommend you go back and listen to that as well. But this is really a fundamental debate, and perhaps we'll get into that a little bit here. I think all of us are mostly on the same page when it comes to this, but I think we can have a little bit of a discussion on that too. But in general, the great debate in options is whether you should approach them from a buying perspective to buy options, or you should approach them from a selling perspective. And there's a prevailing belief, and it is true to a great degree, that most professional options traders tend to lean toward the selling side of the spectrum. And that certainly is the case to a substantial degree. I remember when I first walked on the floor of the CBOE, Dan, I'm sure you probably had a similar experience, and I would bump into all the old timers who had been down there forever. They had two sayings that they loved to bandy about time and again. The first was, when in doubt, palms out, which is, of course, the code for selling. And then, of course, the other one was, you don't make money buying insurance, you make money selling insurance. Those were the two ones I heard all the time, in addition to, turn those machines back on and all the stuff from Wall Street and Trading Places and all those movies, too. But those are the two refrains that were repeated time and again. Dan, I'm sure you heard those down on the trading floor as well.
Oh, yes, if I had a nickel.
So that's kind of the mindset a lot of people tend to associate with professional options traders, and it is true to a great degree. A lot of people who've made fortunes back in the day in the options realm, including some people who are pretty notorious or well known for that, certainly made a lot of that money being short a lot of premium. And of course, the flip side of that is that a lot of people think retail comes into the equation very leaning towards the long side of the fence. And that certainly is true, particularly in the beginning stages of the options equation. When you're first starting out, most people's first trades are probably buying a call, maybe buying a put if they're a little bit more savvy, but usually buying a call. And they start to get a flavor for it from there, and then they start to go from there. And, there's a lot of pluses and minuses to each side of those equations. But before we even get into the pros and cons of each, I think maybe I'll dial it back a little bit more even. And let's dive into your wheelhouse, since you do have your black hat on and your black helmet and you're ready to go over there. Let's get into some of the analytics. We touched on the Greeks several times on this show in the past. I know that's your baby. Let's do a quick overview here of what Greeks are really pertinent to this discussion when we're talking about buying versus selling options.
Well, Mark, what we're really talking about is volatility. And you can kind of simplify the options universe into two different segments of risk: directional risk and volatility risk. So the directional risk is not necessarily really part of this conversation. I mean, any long option strategy or short option strategy can be positive delta, negative delta, delta neutral, what have you. But what we're really talking about here is the volatility component of the trade. Volatility is one of the most underrated thing by newbie traders that there is. You know, so many new traders just don't think about it. They don't understand it, so they figure, oh, I'm not going to worry about it, but it's super important. So really, within the volatility risk component of options, we kind of break volatility down into two different things: realized volatility and implied volatility. Realized volatility is measured by gamma and theta. Gamma and theta are kind of like, two sides of the same coin. Gamma enables long option traders to make money when the underlying stock moves a lot. Theta enables short option traders to make money when the stock doesn't move a lot. So you're basically trading realized volatility with gamma and theta. Now, of course, each of these comes with their detriments. When gamma helps you, theta hurts you, and when theta helps you, gamma hurts you. So there's that. Now, there's also the implied volatility portion of the risk. And that is when implied volatility rises or falls, you make or lose money. So when you buy options, just as you want movement in the underlying stock so that gamma, so that realized volatility helps you, you also want the implied volatility to rise. And so then your positive vega helps you. If you're short options, just like you want volatility in the underlying to remain low so theta can make you money, you want the implied volatility to get low also. And therefore you make money off your negative vega. So that's sort of the Greeks rundown for everything we're talking about here. And, maybe that might be a little crazy advance for some people and maybe not, but it is definitely something you want to start thinking about.
That's why I always tell our listeners, if they're just tuning into us now for the first time here on episode, I believe it's 17, you may want to dial it back a bit and listen to some of the earlier episodes first to become conversant in topics like the Greeks and things, because we, of course, here on the program assume that you've already heard those episodes, so we're not going to go back and do the Greeks every episode, for example. That would pretty much fill up most of our shows just with that topic alone. Now, the whole short versus long premium, the short, or I should say really maybe make it even simpler, the buying of options versus the selling of options debate, because the premium term gets a little confusing for some people. It really comes down to a couple of different quantifiable things. Let's look at the short side first, the selling side first, because that's probably one of the more intriguing for a lot of our listeners, and also one of the dark side is just tantalizing for people. So we'll start off with looking at some of the pros and the cons of trading from the short side, from selling options perspective. First off, these are typically higher probability trades. And what we mean by that is that the probability of these trades paying off and you keeping most, if not all, of the premium, the value you're collecting for selling those options is usually higher than the long side of the equation. And the reason for that is quite simple. We've talked earlier in the show about theta and about time decay. And if you're selling options, time decay is on your side. Time decay is your friend. Every day, these options are decreasing in value. We do another program on this network called Volatility Views, and Dan, you've been on that show a couple of times now, I think. And one of my co-hosts there, Don, is a fan of saying two things. He says, first off, options die a little each day, which is one of his favorite sayings. And the other is that options should be sold or not sold. So I think you can tell which side of the fence he comes down on from a trading perspective. He's a degenerate seller, if ever there was one. But there is some truth to what he says, in that you have that little bit of decay every day, and you're collecting that usually in most scenarios. Now, it's important to remember, if you're trading theta, theta is not a linear progression. It doesn't really unfold always as you want it to. We talked last time about earnings. That's a great example of theta being not really performing as you'd expect. It does kind of its own beast around earnings time, which doesn't really come off quite a bit, and implied vol offsets it, and then it comes off dramatically after the earnings announcement. So there's a lot of times when theta is not a linear progression that you can rely on very easily, but it usually is there in most normal environments. You can count on a little bit of decay to work on your side. And that's really the major pro of selling options, is that you're getting to make the time decay factor, the insurance factor, the premium factor of options work for you instead of against you. And that's what really becomes very attractive for a lot of options professionals. They know they put on these trades, more often than not, they're going to pay off. Of course, the flip side of that, the cons, is that, first off, although they are higher probability trades, the losses, when they do occur, can be catastrophic. They could really blow out your entire portfolio. So you may have only a small percentage chance of your trade going against you, but when it does, if you don't employ good risk management techniques like we've discussed on this show in the past, then you really risk a very potentially catastrophic career-ending loss, as it were. And also, because these are short options positions, they could swing against you dramatically. They typically require a lot more micromanagement than buying options positions tend to do. So if you're someone who's very busy, has a very active life, you have a busy job, trading is kind of an interesting hobby to you, but you only have time to really look at things before the open and after the close kind of thing, short options aggressively and doing a lot of aggressive short options positions may not be the trade for you unless you really put on very risk-defined types of trades. And also, there's a lot of people who just can't stand the stress factor involved in being short options continually. If you're taking tums a lot, you're worried about your positions, if you're checking your P&L every day, and you're worried about your P&L every day, I really should say, as opposed to checking it, then I don't know if short options is really for you. It's a very high stress type of thing, and only you really know your own personal risk tolerance. If you're losing sleep over a portfolio, then chances are it probably isn't worth it at the end of the day, unless you're really making some absurd gains. I would say adjust your trading style to be a little bit more preferable to your risk tolerance. And last, I think, and that's a point I want to get John to comment on too, because this is right up his alley, is really the margin requirements. A lot of people think, well, you're paying out a certain outlay to buy options, but you're collecting money to sell options. So that's a much more efficient use of your capital, and it's a much better way to trade in general from an efficiency perspective. And of course, they forget this little thing we like to refer to here in the options business as margin. And you can end up tying up quite a bit of capital in short options trades. Now, John, I know you walk a lot of your clients and customers through this on a regular basis. So why don't you walk our listeners here through the basics of margin on short options positions, how it works, how much margin is typically reserved for some of the most common trades, and then we'll get into some of the more esoteric type trades.
Sure. Of course, the most common short trades are the naked trade, naked calls and naked puts. Now, for those trades, the initial requirement is the greatest of either 20% of the underlying value of the underlying minus any out-of-the-money amount or 10% of the underlying value. So it's wherever the greatest is. Now, where customers get confused is that when there are some securities that have special margin requirements. These are non-marginable underlyings, leverage ETFs, and certain high-flying stocks. Now, at SogoTrade, we get a list every day from our clearing firm, and some of the underlyings have 1.5 times the requirements, 2 times the requirements, or 3 times the requirements. Now, of course, any leverage ETF that you trade automatically has increased margin requirement by the leverage multiplier. FAS, FAZ, of course. And then if you have any high-flying stocks like First Solar, Netflix, they carry a high requirement. So be very careful with the margin requirements. Also, during periods of high stress in the marketplace, like during the Greek credit crisis, the clearing firm can raise the margin requirements almost arbitrarily. They tell us. But for example, if the requirements went to 30%, maybe a year or two ago during a big crisis, and this will protect the customer and the firm from unexpected shocks in the marketplace. Can I mention one more thing? I want to just mention one thing that Dan hit on when the customers are looking at implied volatility. It's a great way to gauge if you should buy or sell options, but be careful there. And I want to bring up one story, an example. When the IV hit, or implied volatility of the marketplace, hit 80%, which is astronomical during the financial crisis, actually buying premium during that time was a winner. And a lot of customers say, how is that, John? How can that be? Well, it's because, as Dan alluded to, the marketplace was moving more than 5% a day for a short period of time. So just don't look at elevated IV or implied volatility when you sell. Try to figure out why it's so elevated. Earnings, for example, will elevate volatility, certain events. So just be careful looking at, wow, implied volatility is high. There may be a great reason for that implied volatility to be so high.
Yeah, John, you're making some great points. I kind of want to add to, kind of take the ball and run with it from where you left it, and also kind of reflect on what I talked about before. So this idea of, if the market makes big moves, it's good to be long, and the market doesn't move much, it's good to be short. How that manifests itself into profit is being long options, therefore being long volatility, means if there's a big move, you can make a gigantic, hugely leveraged profit if the market moves enough. The more it moves, the better. If the market doesn't move, then you slowly kind of bleed dry. Like Mark was saying, options die a little every day. And then the other side of that coin, if you're short options, how you make your money is slowly. You just kind of grind out a little bit of profit every day. You make your money from time passing. So if you're thinking about being an option seller, it's not one of those mindsets where, oh man, I'm going to kill it on this trade. Today I made, $5,000 on my short option play. It doesn't really work that way. It's time. I had a student come to me once. Oh man, this was, probably about a couple years ago now, but it's a pretty memorable story. This guy calls me up from out of the blue and he says, look, I heard your name before, I saw you on TV or something. Listen, I want to take a class from you because I really need some help. He goes, I feel like I'm doing everything right, but I lost half my account over the last 2 weeks. And I go, geez Louise, what's going on over here? Oh, all right, well, tell me what the problem is. He goes, listen, I've got two of my friends trying to, teach me options, and I'm listening to them both, and I'm doing what both of them are telling me to do, and it's just not working out for me. He goes, I got my one friend who tells me trading options from the short side, doing things like iron condors, is the absolute best way to make money with options. And then I've got this other friend of mine who says he's been making a ton of money in Baidu. And this is back when Baidu was a real mover. It was moving a few percent every day and just like really on a trajectory straight up, and a very volatile stock. So I'm doing these iron condors and that's supposed to work, and I'm trading them on Baidu because that's supposed to be a great stock to trade, and I just can't figure out what's going wrong. And of course, for those of us who have had some experience with buying versus selling, kind of get that difference. What's going wrong is that he was trading a very volatile stock, one that should profit from volatility, where if you were long options, he would have probably been killing it. But he was trading a short volatility strategy on there, and it was doing exactly what he doesn't want to see happen. So, that's sort of the philosophy. It's kind of the long option guys are sort of the Babe Ruth style. You might have more strikeouts than anybody in the game, but you're going to have more home runs too, and you're going to make a lot on those home runs. And then the other one is just selling options is just grinding it out slowly, looking for boring stocks that you think are not going to move.
That's true. We always describe the short premium side of the fence as dark side. It makes it sound exotic and exciting, but in reality, it is very much a grinding mentality. You're squeezing out a little bit here, you're squeezing out a little bit there, you're sweating over a little bit here and there, and it's certainly in the exciting realm. I think knocking it out of the park with a long option strategy certainly tends to be a little bit more exciting for most people. But yeah, that's a good point, Dan, too, about the outlook you have for the underlying, because that very much plays into the style of trade you want to put on. This is what we really tend to promote here on this show and all of the shows on our radio network, is what your outlook is for the underlying is really the key differentiator in how you select your trading strategy. You shouldn't go into anything, I have to be long, I have to be short, that's how I like to trade. Maybe if you really have a strong preference for one way or the other, or you think you're better at one or the other, then perhaps that could play into it. But if you think, for example, like Baidu back in the day when it was moving quite a bit, if you want to get into that one, you think it's going to move quite a bit, yeah, that's a great example. You don't want to be shorting iron condors out there. That's not exactly a recipe for success. And the flip side is, if you're going into a name that you think is going to go through earnings and remain essentially unched for the next 6 months, buying premium probably not the best play out there. You probably want to lean to the short side. So that's certainly something to consider as well when you're thinking about this great schism, this great debate. How do I want to trade options? Well, that's certainly the first thing you should consider is, what do I actually think is going to go on with this underlying, from a movement perspective, from a directional perspective, from a volatility perspective. And once you have a thought process, a point of view around that, then you can proceed to construct your trading strategies. Now, we hit on the shorts, the pros and cons of being short options.
Mark,
oh, sure.
Mark,
do you have something to jump in?
Yeah, I just want to add one real quick thing. We've mentioned this in the podcast before, the rule of 16, and this directly ties into what Dan and you just mentioned. Right now, the VIX, or the volatility of the marketplace, is around 13, which is of course quite low. But there's a thing called the rule of 16, and if you take an IV, you divide any IV by 16, it will tell you approximately the percentage range that we expect to see in the underlying each day. So now the 13 implied volatility in the SPX is implying 0.8% range in the spiders or in the indexes. Now, do you want to sell that? Not me, but maybe you do. Do you want to buy it? I don't know. But look at that number. Now, I'll give you a ballpark, exactly what you were saying, a ballpark number. Volatility is trading at 32. It's implying about a 2% move a day. And if you do your analysis and you think, well, that's low, that's high, then you can go from there and make your decision either to buy or sell.
There you go. A handy rule of thumb, listeners, as you're looking at options and at their implied volatility and trying to make your trading recommendations. Now, let's flip the coin now and talk about the long side of the equation. I think the side of the fence that many of our first-time listeners are going to fall on. What are we talking about here? We're talking about buying options. So, of course, Dan and John just illuminated a lot of the potential problems with that, but let's hit some of the pros first, just really quickly. We'll do an overview. Again, if you listened to our earlier episodes, you know this. If you haven't, go back and dial in and listen to those again. Of course, long premium strategy, the pro of that is your outlay defines your risk, essentially. So if you're paying $5 for an option, that's the most you can lose on that option. You're not going to lose $10 on a $5 position. So your risk is defined at the outset. You know exactly how much you can lose. A big pro of the long options positions that we just talked about is, of course, the potential for that home run, the potential for that unbelievable profit. You don't have that on the short side of the fence. On the short side, you know exactly how much you could possibly make on that trade. And chances are you're not going to keep all of that. Whereas on the flip side, the long options position, you know how much you're risking, but you don't know how much you could potentially make. Your profits are unlimited. And I put this in quotes, and because it really depends on your personality, but long premium is generally more of a stress-free type of trading. It really, compared to short trading, it usually is. But of course, there is that time decay erosion factor, and if that stresses you out, seeing your options die a little bit every day, then perhaps this is a higher stress strategy for you. The cons, of course, of being long premium are exactly what we just hit on. Time is your enemy every day, except for some, random circumstances and some things like earnings, some unusual circumstances. Your options are going to erode in value. So your strategy, whatever your plan is, has to be correct in order to accommodate for that and make up that decay and actually profit on that trade. So at the end of the day, you could end up putting on a long options trade and essentially have the death by 1,000 cuts, because every day you're getting chopped out a little bit here, you're losing a little bit there. And that could certainly be a depressing situation for a lot of traders, watching their accounts erode. I'm sure, Dan, you've heard this. John, I'm sure you've heard this as well. There's nothing more depressing to a new options trader than putting on a trade that is right. They buy upside calls in XYZ stock, but they're wrong in terms of duration. So they buy a 1 month call expecting the stock to go up 20% and in the next month, and instead they were right, but it happens in 2 months instead of one, and so their options expire worthless, and they watch them play out the following month, and they just feel awful. I'm sure you've had that call, Dan. I'm sure you've had that call, John, where the expiration date works against you.
Timing is everything.
Yeah, one thing to that point, this frustration that is probably the number one frustration, which you just mentioned, and again, we've mentioned in other podcasts. The customer says, if I can't win only out of money calls when the stock goes higher, then you know what, I'm just going to sell them. And I always say, hold on a second. Understand why you didn't make money, why this happens. Be prepared for the gain not being as much as you might expect in out of the money options as the stock goes higher. But don't turn that frustration or misunderstanding of options pricing, theory of behavior, into a shift in your trading strategy. That's why, Dan's book is great. Understanding the Greeks is an essential part of being, a great trader. But don't let that frustration turn into bad trading habits or newfound misguided trading strategy.
And, I want to mention this as well, because we have a lot of newcomers to options listening to this show, and they could easily fall prey to some of the some of these sexier pitches we see out there for options education, for options newsletters, etc. One of the most common ones we see these days. It used to be back in the day when we first launched Insider. The most common pitch was the whole make money in any options or any market condition using options, which ended up translating into buying straddles usually, or buying strangles. Typically strategies that were very expensive and suffered from a lot of time decay and usually didn't work out unless you really had the skills to micromanage them and scalp the gamma, which again, most of the people who are hearing that pitch and responding to it typically do not. But we're seeing the flip side of that being marketed a lot these days, which is, of course, that pitch, and you've probably seen it somewhere online or maybe on TV, infomercial, something like that, where the 70, 80, 90% of options expire worthless. So buy my newsletter, buy my book, subscribe to my service, and I'll teach you how to sell options, and you can collect all that free money because all of these options are just expiring worthless, and it's just a smorgasbord of free money. So, Dan, I know you have some thoughts on this. We've talked about this in the past, but illuminate our listeners on what you think about people who tend to beat that drum quite a bit.
You know what, man? If trading was easy, everybody'd do it. Anybody tells you that, there's, guaranteed profits, that sort of thing, and that you can make money in any option, in any market, that kind of thing, show you these huge returns, delete it, mark them as spam, run from them. Kick them in the shins, whatever you have to do, get away from them. It's just not good. Trading is like any other job, it's about getting better at your craft, mastering it, putting on sound trades from the beginning that have either a good probability of winning, and combine that with having a good value trade. Some of these long option trades have a better chance of losing than winning, but if you think you can really make a whole lot in the event it is a winner, it might be worth doing as well. So, it's just about structuring smart trades, learning how to manage trades once you have them on, being disciplined, and taking your profits and your losses at the right times.
I want to add one more thing. We've gone over this in our myth-busting episode before. 90% options, they expire with us, is a myth. I just want to bring up one quick point here. If you look back to, let's say, the last 10 years, we've had about 6 or 7 different events that have happened. We had the long-term capital managed meltdown, the NASDAQ meltdown in 2000, 9/11. We had a credit scare, GM credit square in 2005. In 2006, we had some uncertainty regarding Fed policy and volatility went higher. And, of course, in 2008, the subprime fiasco. So about every 2 or 3 years, even if we have a lull in the market and volatility is very low and the selling strategy is working out and all these options that you sell expire worthless, every 2 years or so or 3 years, you can't predict it. There could be a macro event, and all of a sudden all your winning trades might all go up in flames, overnight. So just be careful. And I think later in the podcast, we're going to get into ways to, if you want to sell premium, how you can do it in a risk-defined manner. And I think that's a really great topic that we're going to touch on in the next few minutes.
And that's right, John. We are going to dive into that right now, in fact. So perfect segue, sir. You're starting to get the hang of this radio thing. But that is really the crux of the argument, the crux. If you take nothing else away from this show and all the episodes we've done here on Options Bootcamp, you should take away this. You should really approach all of your trades with a very defined risk parameter so that you know exactly how much you could win or potentially lose in any given scenario, and be prepared to adjust accordingly. So that's why when I say none of us here, none of our hosts here on this program really have a preference, long or short, I would definitely say the reason for that is because we approach each scenario a little bit differently, like we said, depending on our outlook on volatility, underlying movement, etc. And also because no matter which way we do it, we tend to really put on defined risk type trades. And that works for both sides of the equation, the long side of the equation and the short side of the equation. People shouldn't think because they're buying options that it's sort of this risk-free trade. Your risk is very defined. You have a premium outlay, and that is your risk. That is essentially how much you are risking on that trade. So if you're spending $5 on that at-the-money XYZ option, that is your risk. And one way to mitigate that risk is to, of course, utilize spreads. So the typical vertical call spread, buying the $5 at-the-money XYZ option, selling the $2 a little bit out of the money, perhaps 5% out of the money XYZ option. Now you've knocked your premium risk down substantially to $3 instead of $5. You've curbed your upside as well. But if you're concerned about your premium outlay, you want to manage your stake a little bit more. Remember, at the end of the day, options is like any other financial endeavor. It's about stake management. You want to stay in the game long enough to hit the home run. And that is certainly one way to do that. Whereas if you're mitigating your outlay on a regular basis, you're typically going to last longer in the long premium side of the fence. And that certainly holds true for the dark side, the short side of the equation. Because if you're out there just blasting out short puts or short calls or what have you, without any sort of hedging or without any sort of spreading mechanism to go with that, you're really asking for trouble. You might be profiting and keeping more of your profits, but when it does hit against you, the 1% or 0.5% of the time that it does move against you, it really could wipe you out. You don't really have to look any farther than over this past 6 months or year or so. We saw Netflix get cut essentially in half and then rally substantially back up. We saw other names, Chipotle, a lot of names out there really having very dramatic moves. Apple dropping from 700 all the way down to 450 or so. It really doesn't take much to show you how if you're just naked selling options time and again, without any sort of really knowledge of or interest in putting on some risk-defined types of trades like spreads, then you really are asking for a world of hurt. Again, I recommend you go back and listen to our recent episodes on spreads. We did 2 of them where we really discussed basic spreads, verticals, ratios, things like that, and get some more advanced spreads, the spreads with wings, the iron condors, the butterflies, the iron flies, that sort of thing. Listen to those 2 episodes. That should really give you a strong working knowledge of spreads and how they work and which ones might be right for you. Now, Dan, I know you spend a lot of time working with your students on spreads. Maybe 2 questions for you. First off, where do your students fall on the spectrum? Do they come to you preferring to be long, preferring to be short? Do they fall in the middle, A? And then B, where do you start with them in terms of spreads and really, working them into the spread mindset?
I would say about maybe 70% of traders who come to me looking for education, I would say about 70% of them prefer to be an option seller, 30% to be option buyers. So for the option sellers, trying to talk them into trading with a spread instead of an outright naked option, that's a pretty easy sell unless, they just have a death wish, because spreads are risk limiting trades as opposed to simply being naked options. And you never want to be selling options unless it's part of a spread. I mean, with the rare exception of people who trade cash secured puts with the intent of potentially buying the stock and wanting to buy the stock. Otherwise, spreads are always better, and it's pretty easy for me to convince a typical person. But option buyers benefit from spreads as well. Do I want to spend $5 on this call, or do I want to spend $2 on the spread and have comparable reward?
That's surprising, because I know a lot of people who trade from the quote-unquote dark side, the short side, tend to be so focused on collecting that premium that they sometimes are reticent to do anything to reduce the amount of premium they're going to collect. Oh, you mean I have to spend a nickel to buy this option to hedge my risk? I don't want to do that. That's why people are still, to this day, selling naked options and then not buying them back when they're trading for a nickel or less, because they don't want to put that little bit of outlay, which drives me crazy, and we've hit on this show in the past. But that's kind of what I expected from your clientele, though. I expected the kind of people who would gravitate towards you would be a little bit perhaps more interested in and or sophisticated in options. Those people tend to, for a variety of reasons, gravitate towards the dark side, if you will. So that doesn't really surprise me. Now, John, you told us before a little bit of the breakdown of your clientele, and it has surprised me. I think you're the lone man on the totem pole that I've worked with, at least from the brokerage perspective, that has a preponderance of premium buyers in your audience, which I think, A, is very interesting, and then B, how do they respond to that same conversation, that spread conversation? Are they reticent as well because they don't want to limit their home run potential?
Well, I mean, the one thing, I'll touch on that in a second, but the one thing I wanted to just add about Dan's comment is, we have the world right now where the volatility, or the VIX, or the volatility in the marketplace is very low. And if you have a client, Dan has a lot of clients, we do, even though we have mostly premium buyers. Let's say you have a strategy where you want to sell out of the money puts. But geez, you know what? The volatility is so low now that you need to take much more risk to get that same return. So this is a way where I can turn somebody that likes to sell, let's say, naked puts. I can turn them into saying, hey, how about a call spread? Buy a call spread. If you're looking for upside exposure, volatility is so low here that, this is the way you can give a customer a more balanced approach. But again, our clientele has a tendency to be more premium buyers. I'm not sure exactly the reason why that is. And we have some customers that are very good at it. And, we of course have some customers that, lose a lot of money. But again, what I like to tell people is that if you're going to buy premium, and that's my bias, that's full disclosure, but allocate, let's say 5%, 2%, 3%, a certain number to each trade. They're speculative trades. You could lose your entire premium. And then if you do 2 or 3 trades in a row and now you're down 12% or 10% because they've all busted, maybe take a break. Maybe let's try and maybe do some credit spreads or some other strategy. But just, again, just be flexible, in your approach.
Wise words, indeed, words to live by. I would like to see some research someday on why Sogo seems to attract so many option buyers, because that certainly makes you guys stand out from the crowd. That is a very interesting thing. Maybe it's this show. Maybe people are coming in from the show and they're coming in and they like to buy options because they're new to options. I don't know.
I think one of the reasons may be is that we do have a certain percentage of our customers that are Asian customers, Chinese customers. We have a big push in Asia, and could it be that there's a gambling mentality for these customers? I don't know. That's speculation, but maybe that's one of the reasons. There's more of a gambling mentality to the clientele that we are focusing on.
And there you go, listeners, a overview of the Great Schism, the Great Debate. As I said, we don't really come in on one side or the other. We want to just arm you with the information to make the proper decision for yourself. If you want to learn more about this topic, of course, you can surf on over to theoptionsinsider.com, or you can surf on over to SogoTrade and contact John, and he'll walk you through it. And if you want some one-on-one mentoring, then, of course, you can call up our friend Dan over at Market Taker Mentoring. But now, we're going to close out our Options 101 segment and dive into our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and this is, of course, the mail call segment where you, the listener, get your chance to sound off on the Options Bootcamp program. And first up, we have a question from Tim Nagerty, and he says, Mark and the other drill instructors have repeatedly stressed portfolio margin on this program, but I'm somewhat confused by this concept. Can the host explain the benefits of portfolio margin for an options trader? I have about $70,000 in my trading account right now. Is it worth it for me to transfer in the extra $30,000 to meet the $100,000 limit to qualify for portfolio margin? Lastly, does SogoTrade / Wang Investments offer portfolio margining for its customers? Thanks. Love the show. John, this sounds like this one's right up your alley, so I think I'll let you run with it.
Yes, SogoTrade does offer portfolio managing through another clearing firm we use. It's a brand new offering, which I think it is in the space in general. It's case-by-case approval. You need at least $100,000, although we prefer $250,000 because it's new for us, it's new for the customer. $100,000 would be the exception, not the rule. Portfolio margining is exactly what it says it is. Portfolio margining is exactly what it says it is. Portfolio-based approach to margin. It's what traders on the floor had, what I had, what Dan had, what Mark have. It's for sure the fairest way for larger accounts to get the true margin calculation for their accounts. One of the first things when I came over from the trading world to the retail world was margin was all new to me, this new area margin. And I was surprised to learn all the rules and how much less the retail customer has margin-wise versus a trader. Let me try to explain what portfolio margining really basically is. The new method uses theoretical pricing to calculate the loss of a position at different price points, above and below the current stock price. And the largest loss is then identified as a margin position. So for example, it'll take Apple at 500 and it will look at 10 price points up and down. And wherever you're going to lose the most amount of money, that will be your margin. Now, stock and options positions with regular underlyings, they're tested with, usually about a 15% price changes. And for small cap indices, it's normally about 10%. Any large cap indice that you're long or short, be about 6 or 10%. So it's very important. The stress testing is also done on the position's implied volatility. So basically, this kind of sum it up, basically up or down 15% in your position with the implied volatility up or down maybe 30%, you need to have enough money in your account to cover a potential loss.
All right, John, thank you for that. An interesting topic. If you want to learn more about that, like I said, contact the boys, or I should say the boys and girls over there at SogoTrade, or of course you can search for that term on Options Insider. We did a lot about portfolio margin back in 07, 08 when that was first starting to hit the marketplace, and a lot of people had questions about that. Certainly worth a refresher for you, the listener. Next up, we have a question from Allison out of Spokane, Washington. She says, I thank you all for this wonderful program, and you are quite welcome, Allison. She says, do you have any plans to take Options Bootcamp on the road? I'd love to meet you all in person. Well, Allison, you actually have good timing, because as I mentioned at the top of the show, we're not exactly doing an Options Bootcamp on the road, though that's not a bad idea. Maybe we'll have to do a road tour, John. What do you think of that idea?
Let's go.
Yeah, I like it. But, I mentioned at the top of the show here that we are doing an event here in Chicago on March 27th. Is going to be our Unusual Activity Forum. We won't have John there, unfortunately, but we will have Dan, and I will be there. So it's kind of like a 2/3 Options Bootcamp show. We're going to get into unusual activity, how to parse it, how to find it, how to hunt it down, track it down, and then once you find it, what to actually do with it, how to profit from it, how to avoid a bunch of the mistakes. It's some pretty cool stuff. It's something that really falls into our bailiwick here at Options Insider. We've been doing unusual activity for a long time. We kind of got that ball really rolling a long time ago. So it's something that should be really interesting. If you want to come meet the team, that's a good chance to do it. So surf on over to theoptionsinsider.com. You'll find the link to register for that event. Last up, we have a question here from Joey Beltran. He says, I've heard the term backspread a few times. Where does it come from? What does it mean? And do you use them? Dan, I know you're a degenerate backspreader if ever I met one, so this question sounds like it's right up your alley.
Well, definitely degenerate. Backspread, you can kind of define it two different ways. As a professional, it's really any long gamma trade. When I was down on the trading floor, I was a market maker during the internet bubble, or what's now known as the internet bubble. And there's a lot of volatility. And truth be told, despite the fact that we've been talking about, the advantages of option selling and such, I was almost always backspread. And it was working pretty well during those periods. Now, for a retail trader in a retail account, most of the people listening to the show, a backspread has a little bit of a tighter definition. It's a vertical spread that is two options, both calls or both puts, in the same expiration month, but with different strikes, done in a ratio. But specifically, the trader buys more options than the trader sells. So for example, a trader might do a call backspread and buy and sell one April 50 call and buy 3 April 55 calls. So it's kind of like a vertical spread, kind of like a call credit spread, but there's some extra long calls in there. And sometimes these can be done kind of dollar neutral. Sometimes they can be done paying just a small amount. Sometimes they can even be done for a credit. And the objective is, if the stock moves in the direction of your long calls, you can reap a pretty leveraged profit. If the stock moves drastically in the other direction, like through your short call strike, you probably either break even or maybe even make a teeny bit. But the problem is, if the stock is trading right at your long strike at expiration, that's where you can really just get annihilated. And I'll tell you what, despite the fact that when I was a market maker, when I was backspread, it worked pretty well during that environment anyway. I don't know too many people who have successfully traded backspreads as a retail trader. They can be pretty challenging, and 9 times out of 10, if you're thinking about doing a backspread, if you look for an alternative to what you're thinking about, maybe some sort of butterfly instead, or maybe straight vertical spread instead, or maybe even just a long call instead, you can almost always construct a better risk-reward trade by doing something that's not a backspread.
Yeah, I've never really been a huge fan of backspreads. And it is very much, you're right, a kind of retail-focused term. I never really encountered that term until I left the trading floor. No one came up to me in my pits and said, hey, I'm backspread today. It wasn't a term we bandied about too often. But it was something we did use without really calling it that, because at the end of the day, most market makers were net long units. And that's what you're talking about. From a risk management perspective, you want to have those net long units in case, at the end of the day, the worst does go against you, because you have that to back you up.
One thing about the backspread, and this kind of ties into the portfolio margining, a backspread is a perfect example of, if you put a backspread on, at least for SogoTrade, and I'm sure most other margining with the margin as is now, they're gonna margin you, in a certain way that might not be advantageous, whereas the portfolio margin might give you, a better margin profile. I just want to touch on one thing again very quickly, in case I wasn't clear. Portfolio margin is the risk of your position up or down 10% with implied volatility up or down 30%, versus what we have now, the old method of this Reg T margin or strategy-based margin. And it's a fair way, in my opinion, to calculate margin for a customer or for an institutional trader.
All right. Thank you for that, Dan and John. And unfortunately, I'd love to keep going, but that's all the time we have for today's episode of Options Bootcamp. But before we go, I'd like to check in with my cohorts here on the Options Drill Instructor Squad to see what they have coming up in their neck of the woods that may interest you, the Options Bootcamp listener. Starting off with you, Dan, what is coming up in the land of market taker mentoring?
I have got some really exciting stuff going on. I am holding this is my first in-person class where it's just me and another individual putting on this live 2-day seminar in scenic Las Vegas in April. And if anybody would like to attend the class, meet me in person, you get all these extras kind of thrown in. It's an incredible value. Email me, dan@markettaker.com, and I can show you how you can sign up for that class and give you some more details.
2 days of Dan Passarelli. What more could you possibly ask for? Except perhaps half a day in Chicago talking about unusual activity. There you go. All right. And last but certainly not least, we have the major domo, the options specialist over there at SogoTrade.com. And John, you just hit on the fact that you guys added portfolio margin. That is certainly a big addition to SogoTrade. So why don't you hit on that again really quick, and then let our listeners know what else may be coming up in the land of Sogo.
Sure. We offered portfolio margin. Again, it's case by case. We have a few clients. We do it through another clearing firm. So the process is pretty complicated on our end, but we are willing to work with large accounts to see if we can facilitate that. Since our last podcast, we now have a new website. So come check it out. Easier navigation, more features. And I've been promising this for about maybe since the beginning of the podcast. We now have our SogoTrade blog up. It was just rolled out. If you go SogoTrade.com on the pre-login page under education, you'll see it. And I write there maybe once, a few times a week. And you can also subscribe to it to the blog on this page. And, of course, you can always follow me on Twitter, SogoTrade Option, SogoTrader on Twitter, Facebook. And next week, I will be in New York at the Traders Expo. I'm not presenting, but I will be there. And I'm probably going to see Dan, and it should be a lot of fun. So any customers, you can come out to the expo and see Dan, and maybe you'll run into me also.
All right. Thank you for that, John. And that is going to do it for this episode of Options Bootcamp. Before you go, I want to, of course, remind you, the listener, to surf on over to theoptionsinsider.com. That's where you can find out more information about our upcoming March 27th event here in Chicago. You can also listen to all of the archived episodes of this program, Options Bootcamp, so you can catch up on all of the material you may have missed if you're just joining us now and tuning into the show for the first time. And last but certainly not least, that is also where you can send us a question or a comment for our mail call segment. You can leave them in our comment section. You can use that comment section to send us an email. Of course, you can find us on Twitter or on Facebook, or you can just shoot us an email directly, questions@theoptionsinsider.com. Just put question for Options Bootcamp in the subject line so we know which show you're referring to. And of course, all of us here on the Options Bootcamp Drill Instructor Squad want to thank all of you out there in the listening audience for tuning into this program and downloading it and streaming it and subscribing to it. And of course, for sending in all those great questions. We love to hear from you guys. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by SogoTrade, an extraordinary value in online trading. Why pay more for the same trade when SogoTrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.